Unmuted.
Hey everyone, thanks for joining us for the Trends in FinTech webinar. People are still trickling in, so we're just going to give them a few more minutes to join.
Muted. Unmuted.
All right, hey everyone, thanks for joining us today. Just a few housekeeping items before we get started. If you're having any technical issues throughout the webinar, please go to the GoToWebinar support desk at Citrix. They'll be able to help you with any audio or slide resolution issues that you may be having. During the webinar, if you have any questions for Matt or Daniel from KPMG, feel free to reach out in your GoToWebinar console or go on Twitter with the hashtag FinTech. Okay, so just some background on KPMG and CB Insights. KPMG Enterprise advises businesses from the seed stage to exit with extensive knowledge and experience in the startup ecosystem. KPMG FinTech professionals use their global network and knowledge to accelerate your FinTech strategy. Some background on CB Insights. We are a data science and machine learning organization backed by RSTP and the National Science Foundation. We help you navigate the private market space and identify your next customer, investment, acquisition, or market to attack. In the next slide, you can see a few of our happy customers. And just to give you some background on Matt before I hand things over to him, Matt is a senior research analyst here at CB Insights, focusing on FinTech, of course, digital health, EdTech, and on-demand. Before CB Insights, Matt completed a short stint covering startups and venture capital at Dow Jones VentureWire and Inc.com. Matt's published industry research and analysis have been featured in the New York Times, Wall Street Journal, Financial Times, Bloomberg, and CNBC. He's also appeared on Bloomberg TV, Al Jazeera, and Business News Network. All right, so I'm going to hand things over to Matt now to kick things off.
Muted.
Great. Thanks a lot, Alyssa. So before we get started, this is sort of our mantra as we sort of run through the webinar today on FinTech is in God we trust, all others must bring data. So I try to avoid a lot of the punditry in the space and sort of bring you guys sort of a data-driven perspective of what we're seeing in the space across geographies in the FinTech ecosystem. So just in the next 30 to 40 minutes, we're going to run through a few areas. I'm going to introduce Daniel, our sort of featured speaker from KPMG, who will be chatting about trends in robo-advisory. We'll then go through sort of a state of FinTech, macro trends we're seeing in the global FinTech landscape. And then very quickly, we'll just run through the latest numbers that we're seeing in North America, Europe, and Asia. All of these were released a couple weeks ago in our joint KPMG CB Insights FinTech Pulse report. And we'll be sending you guys a link to that as well later. So I just wanted to introduce Daniel, who's our speaker today, and we'll be talking about robo-advisory. Daniel O'Keefe is a principal at KPMG Strategy with over 30 years of experience working with clients across the banking and wealth management sectors. He's also sort of the subject matter expert for KPMG in robo-advisory. So without further ado, I'm going to introduce Daniel, and he's going to chat with you guys about trends in robo-advisory.
Thanks, Matt. So glad to be on the line with you all this morning. We wanted to share with you some of the insights we see from our primary research that we're conducting, our work with clients, and our work with fintech startups really focus on the robo-advice and digital advice space. We think it's a very exciting time, and a lot of really interesting activity has occurred really in the past 6 months. What we really see is that digital advice is evolving quite rapidly, where we saw early movers really get into market with some initial offerings that provided asset allocation models and access to investment advice in ways that didn't exist previously. We see an evolution happening that will really involve a much more holistic view of a client's financial well-being, where it's not just around asset allocation, but we'll look at income and liabilities and the entire kind of balance sheet of an individual and provide advice in a much more holistic way. And we'll talk a lot about that as we kind of go through today's discussion. A ton of investment activity. There's been a growing number of deals in this year, especially in the first part of 2016. And the activity just continues to increase, both in terms of investment deals that you see summarized on the page right now, as well as opportunities where you're seeing a large number of fintech startups and robo startups doing deals with institutions, and we'll talk a bunch about that in a few minutes. The mix of activities is changing, and this is really being driven outside the U.S. as much as anything. So we're seeing a huge amount of seed activity in the first part of this year. What we've talked to many of our clients about is that the barriers to entry are quite low, and what we're seeing is just a very significant increase in the number of startups that are launching and beginning to make some waves in the marketplace. Again, this is a trend we see continuing. So what do we see happening kind of really in the robo-advisory space? Clearly the U.S. has been leading the charge, and U.S. AUM at the end of last year was really around $42 billion, but that's really just the tiniest tip of the iceberg of the $50 trillion of U.S. private wealth that exists with that is fully addressable. The biggest pure plays clearly are Wealthfront and Betterment. They're the acknowledged market leaders in the U.S. and have a tremendous amount of AUM and press and have raised a lot of funds. But if you look at in terms of where are the largest platforms in terms of asset under management, it's really the Schwab Intelligent Portfolios and Vanguard Personal Advisor that dominate in terms of AUM, and they're largely doing it through cannibalization of their existing client relationships, though over the past several quarters we see a growing trend towards net new investments on those platforms. The other very interesting thing that you've seen a lot, especially in this past quarter, is a lot of deals and a lot of activity that really points towards more cooperation from many of the fintech platforms, robo-advice platforms, with financial institutions. The economics of the standalone platforms is still far from proven. The customer acquisition costs are quite high, and so what we're seeing is more and more deals where the fintech platforms are partnering with financial institutions to really be the enabling technology platforms behind their digital wealth offerings. And this is really all in an effort to kind of reduce that customer acquisition cost, to get out in the marketplace and get more volume, and to really prove the value of their models. And so we see this cooperation, if you will, and joint deals happening quite quickly. The other point that is interesting is really around the regulatory environment. And without a doubt, the regulatory environment is not consistent across the globe. While in the U.S. there has been a lot of advancement and deployment of robo platforms, when you look across the EU and elsewhere in the world, the regulatory environment is much more restrictive and is really causing some impediments to the growth of the robo platforms. Within the U.S., the recent DOL rulings around the fiduciary standards are also having an impact and will have an impact on the deployment of robo platforms. In some cases, we see the DOL ruling as being very supportive and positive towards the deployment of robo platforms. If, on the other hand, you're using your robo platform as a distribution channel for your ETF products, some of the DOL implications will actually be an impediment and may very well cause you to have to rethink some of the distribution strategies. Looking forward, we continue to see very robust growth over the next 12 months. We see that happening both with the pure seed funding and Series A, B, and C, et cetera, that will enable these platforms to grow. We think the shifting demographics and the large generational wealth transfer that is out there is going to continue to expand and fuel robo-advice. And we really see the platforms evolving quite rapidly. As I mentioned at my very opening comments, where we see the changes happening, if you see version 1, if you will, of robo platforms as asset allocation models, that's what's in the marketplace today. And they're allocating the assets under management within that given financial institution. Version 2 is going to drive a lot more account aggregation and advice that spans not only the assets within a given platform, but a broader set of assets that you may have at custody in other institutions. And we see that already happening with some of the announcements in some of the players to really drive a much broader account aggregation capability. And then we would envision kind of version 3.0 of robo-advice to be that much more holistic look beyond just your assets, your investment assets, but all of your assets and liabilities and financial needs. And that's where we see the robo-advice platforms really evolving over the next, kind of 12 to 18 months. So with that, that's kind of our overview from a robo perspective. We'll be happy to take questions as we get through some of the other materials.
Great, thanks a lot, Daniel, for that. So next we're going to dive into sort of the state of fintech through Q1 of this year. So we'll look at some of the macro trends in the global fintech landscape. So just briefly, what are we covering when we talk about fintech? There's 8 main areas that we're covering. You'll see them as they appear here: lending, payments and billing, personal finance and asset management technology, money transfer, blockchain, capital management, equity crowdfunding, and as well as sort of the growing world of insurance tech. So when we look at sort of the numbers through the first quarter of Q1, VC-backed fintech companies raised almost $5 billion across 218 deals in the first 3 months of the year. When we look at the breakdown of funding by quarter, you see sort of the portion of the funding and deal activity that VC-backed companies are taking versus sort of the overall fintech landscape, which would include companies that are angel-backed or PE-backed or just have not taken VC funding. So here you see sort of VC-backed fintech companies taking 86% of the overall fintech funding in Q1. If you take sort of the entire universe of fintech, we see sort of funding rise to $5.7 billion across 468 deals. When we look at sort of the quarterly breakdown of the VC-backed fintech activity over time, we see sort of the deal and funding activity see a big rebound over sort of what we saw in Q4. So, you know, when we look at sort of Q4 at 2015, $1.9 billion was invested across 179 deals in Q4, and in Q1, when we sort of fast forward ahead, we see sort of that increase in both funding and deals. When we look at sort of why that's happening, mega rounds are a large part of that. So when we talk about sort of the $50 million plus financings to companies in the fintech space, here's sort of this chart. Will show you in the last 5 quarters how many of those deals of $50 million or higher occurred throughout North America, Asia, and Europe. So we saw an increase in North America from sort of that Q4 drop-off of larger deals, Oscar and Betterment being 2 of those. Although one notable trend is we haven't seen sort of an uptick in $50 million deals in Europe, and that's something we'll talk about a little later as we dive into sort of the geographic trends there. Corporates are also sort of a big area that continues to be sort of a focus for fintech. So, you know, when we look at sort of how many of the fintech investments involved the corporate, it was over 25% in Q1, and that's sort of in line with sort of what we've seen in recent quarters, where, in fact, all the past 5 quarters have seen over 1/5 of deals involve a corporate in terms of VC-backed fintech companies. When we talk about sort of the major banks involved in fintech, sort of a growing trend is just the amount of strategic investment by sort of the biggest banks in the world. So this is actually a global trend that we're seeing, where Goldman Sachs, Citigroup, as well as Banco Santander through their venture arm, Santander Interventures, are all doing deals to sort of the VC-backed fintech landscape. You see some of the other names there who have done deals in the last 5 quarters, including JP Morgan, and also internationally banks like Mizuho, as well as Mitsui Financial Group in Japan. So here you see sort of just that sort of rise of the number of banks who are investing in VC-backed fintech companies, sort of using strategic investment to understand sort of this landscape of activity in the fintech landscape. So this idea of sort of unbundling a bank, you know, has been something that we've been talking about for a while and has been sort of in the discussion landscape within fintech for a while. But just the continued amount of startups who are sort of taking apart one, you know, area of a bank and sort of doing that well. You sort of see this increasing number of startups, and that continues to this day, where we just so this graphic that sort of looks at Wells Fargo's homepage and looks at the amount of startups that are sort of focused on one of the singular aspects of their business, and you see just the growing amount of startups that continues. That said, you know, one trend that is noticeable is sort of this increase of fintech and incumbent partnerships. So we've seen sort of this unbundling narrative sort of give way to more cooperation, something that sort of Daniel mentioned in his earlier slides. But here you see some of the sort of recent partnerships between fintech startups as well as incumbents. You know, earlier last year, you know, we saw Lending Club and Citigroup, as well as OnDeck sort of partner with JP Morgan to the public lending startups. Previously lending startups who went public, as well as you see some of the others there that have taken place. So this sort of rise of partnerships and more cooperation is something that we continue to see, and that's sort of, you know, going across all areas of the fintech landscape. Here's a recent quote from Scott Miller, who's the VP of Global Partnerships at TransferWise, the money transfer startup in the UK, on canvassing the US for bank partners. So here you see, you know, about a year ago we realized that not everyone is going to come to TransferWise to transfer money, so wherever they are, we should go to them. So this idea of sort of more cooperation, looking for partners in the banking sphere for partnerships, and I think sort of this emphasizing this tone. When we look at sort of the recent headlines in fintech, though, things can sort of appear pretty gloomy. So if you look sort of just Lending Club, who recently saw their CEO resign, OnDeck Capital, you know, also in the news, Prosper, Square, Lufax, and others. So the headlines sort of suggest one story in fintech, and sort of you know, how things might appear. And when we look at sort of the landscape of billion-dollar companies, private billion-dollar companies in the fintech landscape, things certainly, you know, have in some cases taken a turn. Prosper, you know, shedding a portion of their workforce. Zenefits, the health insurance startup, you know, also seeing the resignation of their CEO. So, you know, I think one thing is, you know, while we're seeing some of the recent headlines and news come out of the fintech landscape portray one story, I think it's not entirely all negative, and we'll highlight some of the areas where we're seeing sort of as a bright spot within the fintech landscape. So one way you can do that is sort of look at where sort of the brand name VCs are doing their new deals and where sort of the new investment's going. So when we took a sort of a recent survey of where 23 brand name investors like Sequoia Capital, Andreessen Horowitz, Union Square Ventures, and others are investing and doing new deals in fintech, we see a few sort of hot areas appear. Insurance is one area we'll talk a little bit about. And then there are others. So, you know, real estate investing, we've seen deals to companies like Cadre, Realty Shares, Roofstock. We've also continued to see sort of big investments into the point of sale credit and alternative lending space, where companies like Affirm and Bread Labs have raised funding. Insurance, we're seeing that, you know, first bear out in terms of the health insurance space, where we've seen startups like Oscar, Zenefits, Bright Health, another startup in that space, which plans to target Colorado as its first market for health insurance, backed by some big name investors as well. But that's also given way to startups in other lines, including PNC and life insurance, where you see companies like Ladder Life, which is a company that's soon to launch in the life insurance space, Jetty, a company in sort of the renters insurance market. So we're seeing sort of that give way to other markets as well. And then lastly, you know, we're also seeing sort of VCs also do a few deals in this area of sort of institutional investing tools. So if you think about sort of the analysis and sort of ability that sort of big data analytics has given way to in institutional investing, that's sort of created a number of companies who are either building out sort of proprietary data sets or sort of analyzing those. We'll talk a bit about that as we move on. Just going a level deeper into the sort of insurance tech landscape here, you see sort of the deal and dollar trend to insurance tech over time, and sort of quarterly deal activity hitting a all-time high in Q1. When we look at sort of where those deals have taken place in the maturity spectrum, a large portion, as we mentioned, is at the seed stage. So this is an area that's still very early in the fintech landscape, where, you know, most of the deals, over 60%, are happening at the seed or Series A. Bitcoin and blockchain, I'll just touch on quickly. We did see sort of a funding increase in Q1 after sort of a consecutive decrease in funding activity in the space. A large portion of this is driven by strategic investment and corporates. In fact, last year, sort of all 5 of the largest deals involved a corporate in terms of the Bitcoin and blockchain landscape, and we've seen that sort of continue into Q1 2016 as well. This idea of sort of alternative data and institutional investing, which I touched on a bit earlier, not all of these companies would be considered fintech, but definitely a portion of those would be. So we mapped out sort of what this landscape is looking like, and you see sort of the number of startups in this area that are providing sort of, you know, new data sets in things like foot traffic, weather, credit card transactions, and others. And we're also seeing sort of a number of startups who are helping to analyze these sort of new alternative data sets as well. When we look at sort of the segment of companies, you know, it's not just sort of industries, but also, you know, segments of the population where we're seeing a large portion of fintech startups go after. So, you know, a number of fintech startups are targeting the underbanked and raising institutional capital to do that. Branch International is one company that's providing sort of microfinance and micro-lending in Africa. Just recently raised funding from Andreessen Horowitz, and we're seeing others like Even here in the United States, helping sort of stabilize paychecks for sort of high-risk populations, and where it's and we're seeing that sort of bear out in other areas as well. So with that, you know, I'm going to dive into just very quickly run through numbers we're seeing in the major geographies in fintech. When we look at North America, in line with sort of the global trend where we saw a rebound in both deals and dollars, in North America, fintech funding, $1.8 billion was deployed across 120 deals in North America. One interesting trend in North America worth paying attention to is we are sort of seeing late-stage deal sizes drop a bit. So Q3, and there was a number of sort of major mega round financings to the fintech landscape, including SoFi, which raised over $1 billion from SoftBank. And we're seeing sort of not as many late-stage mega rounds in North America of that size, or of sort of the larger size, as you see sort of in this chart. When we look at sort of just the seed deal share in North America, that's a trend that we're seeing sort of drop a bit compared to other stages. And here you sort of see the breakdown of deal share in North America. Series B deal share also dropping in Q1 16 to 14% from 21% in Q4. CVC participation in North America also sort of in line with what we're seeing sort of globally, where corporates and strategics are involved in about 1/4 of deals in North America fintech. Here you'll see sort of the most active VC investors in North America fintech startups in the last 5 quarters. I think what's interesting here is you're seeing some names that are singularly focused on fintech, or sort of making fintech their sort of domain. Those are firms like Nika Partners, QED, and others, and as a result of that are among the most active investors in fintech overall, ranking alongside some of the larger multi-stage firms here like NEA and Kleiner Perkins. Just quickly, I'm just going to touch on California. We've seen sort of deal activity remains somewhat level in the last few quarters. Some of the largest deals there in the last 5 quarters, including Affirm, Zenefits, and SoFi. And then New York, conversely, saw sort of a big uptick in funding, large part due to big deals to Oscar, as well as Betterment. So you're seeing sort of that influx in funding into New York fintech over the last few quarters. When we look at Europe, funding has remained much more level in quarters. We haven't seen sort of a large uptick in funding on a quarterly basis to European fintech companies, though we did see slight increase in deals there in Q1 to the European fintech landscape. Here you see sort of the breakdown of deals by stage in Europe, and you see sort of a drop in C-stage activity in European fintech, although you did see an increase in Series A deals in the same quarter. So we'll see, what happens. Are we going to see sort of more mature companies in Europe raise capital, which will lead to some of those larger rounds? I think that's definitely something to be on the lookout for. One thing that has been interesting that we've tracked in Europe is sort of a different trend when it comes to strategic and corporate involvement in fintech deals in Europe, where in some quarters the involvement was as low as 8% or 10%. We did see that increase in Q1. So what will sort of the rest of the year look like in Europe as for strategic investment in fintech? As we've seen, some European strategics and banks become, somewhat active in the landscape, including Santander, Ventures, and others. Here you'll see sort of the most active VC investors in fintech in Europe, names like Route 66 Ventures, Holtzbrinck, so sort of mostly Europe-specific funds, Europe-headquartered funds in the fintech landscape there in terms of the most active investors over the last 5 quarters. Here, just quickly, a look at UK, and then a look at Germany, where we're seeing sort of an increase in deals in Germany in Q1 16. You see some of the larger deals there over the last 5 quarters, including SpotCap, on the insurance tech side, Friendsurance, which is a sort of P2P insurance brokerage, and Creditic as well, which recently raised a funding round. Just quickly, just to finish up, we're going to look at just Asia financing trends. So Asia has seen, a few notable spikes in recent quarters, including Q1, where we saw a few major deals that we'll touch on later account for sort of, the bulk of funding activity to Asia fintech. So, you see sort of the up and down trend here in Asia fintech in terms of dollar amounts, dropping in Q4, and then sort of rising back up on the back of a couple mega deals. Here, just a look at the breakdown by stage. C-stage activity accounted for a large portion of activity in Asia FinTech in Q1 16. But one thing that we'll mention is corporates have been sort of overwhelmingly involved in a large portion of the deals. In Asia, you have sort of the presence of large internet giants, especially in China, like Tencent, Alibaba, Baidu, and others. And some of those haven't been afraid to also participate in some of the larger deals. Two companies have also set up joint ventures and partnerships in the fintech space, as you see sort of companies like Alibaba and Tencent, compete for share of the digital wallet space and other areas within financial services. So when we look at sort of the most active VC investors, here just to look at some of the names: East Ventures, 500 Startups, Excel, as well as on the corporate side, Mitsubishi, UFJ, and others. As I mentioned, the large sort of spike in funding to China FinTech was sort of largely driven by Lu.com, which raised $1.2 billion, as well as JD Finance, the financial services arm of JD.com, which raised funding in a deal led by Sequoia Capital China. That deal totaled $1.01 billion. India sort of seeing a big drop in funding. In previous quarters we saw Paytm sort of raise large amounts of capital, and we didn't see sort of any sort of big growth financings in India FinTech, both in Q4 and Q1. So we'll see, whether that trend continues or whether sort of we will see sort of larger deals emerge in the India FinTech landscape moving forward in the next few quarters of 2016. So with that, we're going to move to questions here. Victor from our team has been gathering a host of different questions that the audience has, or you guys have been sending in to us. I will mention again that a lot of the data that we presented and ran through very quickly in this presentation is available in the FinTech Pulse report that we put out last week, and that's available for download. We'll also probably include a link to you guys for that report, as well as in the email we'll follow up with. So with that, we'll go to questions. So we have one for Daniel here, which I'm just going to read off. Daniel, one of our audience members, asked, will robo-advisory provide behavioral insights of the user?
So, some platforms absolutely will do that, and there's a view that I need to go beyond kind of the traditional questionnaire and profiling of risk, but also look at how do individuals behave and act over time, and that will ultimately provide more insight that I should factor into my allocation models. And so the intent is absolutely, for some platforms, to absolutely take more of a behavioral model and gauge their advice based off of an individual's actions over just their stated intent. But that's going to take some time to get here. That's not going to be in the Betterment model next week, for instance. That will take time to really embed some of that behavioral science into the process.
So we have another one, just going off that one. Will robo-advisory represent the end of the private banker?
I don't believe so, but it's also going to depend at what kind of wealth bracket you're talking about. Clearly we believe robo-advice will provide and give access to better information and better financial advice to lower value, if you will, client segments. But the high-end private banks aren't going anywhere because their service is highly specialized and highly valued by the high-end client segments that they serve. What we see at the higher-end clients is the use of digital platforms more as an enabler for their FAs as opposed to a replacement for their FAs.
And then I'm just going to follow up with just the last two questions on the robo-advisory side. So Daniel, if you want to just take these. One is, to what degree are institutional funds and portfolio managers using robo-advisors for their portfolios?
So if I understand the question, so is it enabling the institutional guys to do asset allocation models? And the short answer is no. We're not seeing the adoption of digital advice platforms to support institutional advisors as something that is getting much traction. Over time, perhaps, but not yet.
And then the last question here is, you mentioned Betterment and also Wealthfront, but where do you see sort of personal capital, if anything, sort of in application? Where are they in terms of V1, V2, or sort of their state?
So the data I'm looking at, personal capital is raised, over $100 million. They're absolutely a very interesting platform and are really looking at how do they crack the distribution nut, right? So how do they get their product out into the hands of investors through a variety of channels? And so, they are, by my numbers, they've raised about, they're in the top 5 in terms of capital raised, and I think are going to be a long-term player. But they don't yet have the same level of AUM that some of the other platforms do.
Great. And then sort of the last question on the robo-advisory side, who do you think will win the robo-advisory space, if there will be one? Will it be sort of the independent or robo-aligned with the large institutions?
So I believe it's going to be the robos aligned with institutions for 2 reasons. One, we did a bunch of primary research earlier this year to really understand what do clients really value and what do clients want in terms of a digital advice platform. And one of the most important characteristics was really the ability to have an integrated financial and banking platform. So, they want more than just, asset allocation within my Schwab portfolio. They really want an integrated experience, and I believe the larger institutions will be able to deliver on that more effectively. The second reason is, the customer acquisition cost for the pure plays in comparison to the return you get, given the very low price points that exist today, make the economics of those businesses highly challenged. And so you're going to need to partner to increase your reach, your distribution reach, and your client reach. And so we see those platforms that are doing it, Future Advisor being a great example, after their acquisition by BlackRock, has inked deals with many institutions, and we think that's going to be the model that is most successful.
So we have a couple questions here on different areas. Are there any unicorns in the insurance tech space? There are a couple thus far. So Zhongan is one company in China, which is the first internet P&C carrier, internet-only P&C carrier. It was initially started as a joint venture between Tencent, Alibaba, and Ping An Insurance, and others include Oscar, so the New York-based tech-enabled health insurer, as well as Zenefits, which, if you think about sort of the opportunity for insurance distribution through sort of incidental platforms, so offering a service other than insurance, like free HR software in the case of Zenefits. They've had been in the headlines a bit recently, but on the back of strong growth to sort of through that insurance business, which they've capitalized through a pretty clever incidental channel. We've got a question here on where do we see sort of the fintech exit landscape? It's definitely been weaker. We didn't present any data here, but the data indicates that we haven't seen many big exits in the fintech landscape recently. I think one thing that was interesting was we saw recently the acquisition of Honest Dollar in the retirement space, sort of providing retirement benefits by Goldman Sachs. And we also saw earlier before that, which Daniel mentioned, sort of Future Advisor acquired by BlackRock. Will we see sort of more acquisitions by major sort of financial services firms into the fintech landscape, especially at an earlier stage? I think that will be something to keep an eye on as sort of Goldman Sachs made its first early stage fintech investment to date. Question here on, what do we expect sort of the insurance tech funding and deal increase to continue? I think, it's uncertain whether each quarter will see sort of a new high in terms of funding and deal activity in insurance tech. But I will say that I think there's certainly a lot of interest both from the multi-stage VCs who are all, if you even look at the amount of investors who are simply just blogged about it or publicly talked about sort of their interest in the space as an indication, and then also on the corporate side where we're seeing the continued increase of new corporate venture arms in this space. So just recently, Liberty Mutual announced $150 million allocation. So if you look at sort of just the amount of capital that each of the new corporate venture arms alone have, that's quite a bit of dry powder to invest over the next few years into both insurance tech and spaces ancillary to it. The other thing that I think will be interesting in the insurance tech space on the investment side is sort of cross-border activity. So we've seen recently just a couple deals from Asia into U.S. companies. So Fosun, for example, in China invested in a company called Sure, which is doing micro duration sort of flight insurance, and I expect that we'll see more investment activity out of Asia into sort of even the U.S. Insurance tech landscape as well. So with that, I think we're gonna, I know we have a lot more questions that we have here, and we're gonna get to those by email to you guys and try to get to as many of those as we can. But I want to thank all of you guys for joining, both Daniel and myself, on this webinar today. Hope you guys enjoy the long weekend, and we'll see you next time. Oh, just quickly before we log off, I will mention that CB Insights is hosting the Future of FinTech conference next week. We also have a live stream which we will be sending out as well on that. So we'll get that link to you as well if you guys like to see. We have speakers there on sort of all spectrums we mentioned today, from wealth management to insurance tech. So thanks again, and we'll see you guys next time. Thanks.